The problem with the sign of strength in the methodology was that it was defined as a sign of strength was defined as a sign of strength bar. And usually when I would ask a student to define a sign of strength, they would usually say, well, it's a bar that has an increasing spread to the upside and increasing volume signature. And that was kind of like a definition for the sign of strength. Well, first of all, that's not necessarily a definition of a sign of strength. It could be even a definition of a sign of strength bar. It's a characteristic. We know that the characteristics of the sign of strength bar are going to be exactly that: increasing upspread and increasing volume signature. But it's not necessarily a definition for a sign of strength rally. So let's look at this. A sign of strength bar is going to be this, right? A bar that is increasing in spread and increasing in the volume signature. This bar does not qualify as a sign of strength rally. A sign of strength rally definition is going to be a rally that travels off the lows in phase C throughout the whole range, that commits above the area of the resistance that was created by phases A and B. So we see that commitment right here. That spends time above that area or in this area, and then that has a backing up action that suggests that comes exactly to the area of the support that acted before as the resistance and was created in phases A and B. And that's the definition of the sign of strength rally. So this I definitely want you to remember, because I will be asking you many times, what is the definition of the sign of strength? What is the definition of the upthrust? And you should remember this by heart. All right. What else? So a big difference between a sign of strength and a sign of rally and a sign of strength bar. So in all of the cases, what we're looking for is the commitment, right? So commitment to the upside, if this is a sign of strength. Off the lows in phase C, through the trading range, commitment to the upside, and then a backing up action that comes exactly to the area of the support that acted before as the resistance. All right, great. Okay, so this one is interesting. So let's have a volunteer. Just say yes, and I'll unmute you. And especially the first trading range. I wonder, guys, how you would be looking at that, how you would define that. Okay, so volunteer. No volunteers? All right, Nilesh, okay, let's go to you. How you doing?
Hi, Raman.
Say again your name so that I would pronounce it correctly.
Nilesh.
Nilesh, okay, great. Okay, so Nilesh, trading range number one, how would we label it? What catches your eye?
So, beginning of the September, right? That seems to me like a selling climax. There's a price tried to go down, and
Price first goes up.
right.
Yeah, so what is this initial move to the upside then, after the
That
selling
would be
climax?
automatic reaction, and then it's kind of combined in the single bar, I would say. The selling climax as well as the automatic reaction happened kind of on the same day. That's how I think I would interpret that.
Yes, that's totally correct. The same day exhibits both selling climax and automatic rally. Okay, so then the next reaction and the next low as a high low could be labeled as
Secondary test.
And that defines
Phase A.
phase A. The intention of phase A is
Stopping action.
stop in action. Great. What are we stopping?
The downward movement.
Okay,
Uh,
great. So now that we've stopped that, now we could define the resistance and the support. So we always will start with the horizontal range. And that's my suggestion to all of you. Sometimes, I hear questions that's when do we start, putting the downsloping or upsloping resistance and support? Well, initially, always put the horizontal boundaries first for the range. This is where the majority of the time the price would spend. And then once you start seeing lower lows or higher highs, that's when you could go in and establish, more of the downsloping environment. Okay, so what is next? What catches your eye next in this trading range?
right. Then in phase B, there are series of secondary tests forming
But is
higher.
this is phase B the most exciting to you as you look at this chart, or are you just going sequentially?
Yeah, I was just going sequentially,
Okay,
but the most
well, yeah. So let's just pay attention to the question itself. What catches your eye, and not necessarily what comes next.
the downward movement, right, which happened around the phase C test, right, around October, right?
Okay,
The rally, yeah, the downward reaction, and then the test that happened around October. That
okay.
catches my.
So how do we label this whole thing here?
That would be phase C.
Okay, phase C, and how would we label, this price action in phase C?
Spring.
Yeah, could be a spring. Obviously, it has all of those characteristics of the spring, where there is an attempt to commit and then the recovery, quick recovery. My only hesitation here is the volume signature. So such a big increase in the volume signature. Um, so this also could suggest that it could be labeled also as a potential shakeout. Especially if you're using the horizontal range, then somebody might say like, yeah, I see a lot of volume, I see a lot of penetration below the support area. I think spring is better here at this spot just because we don't see big commitments to the downside in this phase C. All right, so if this is a spring or a shakeout, then what comes next after this phase C?
Sign of strength rally.
Okay.
Uh, yeah, that's the one. And then we have a backing up action.
Okay, great. And then everything in between C and A is B. And this attempt to overcome the resistance and commit to the upside with the return into the trading range, we would label as
Upthrust in phase B.
upthrust action in phase B. Okay, great. So, and here is our whole labeling. One of the things here was the horizontal range. If we're thinking that this is it, look at the sign of strength, how it comes to the point of the resistance, and it doesn't overcome it. So if you're using the horizontal range, then it's going to be really difficult to contemplate about this at this spot. Why is it failing at the point of the resistance? Is this a sign of weakness by itself, right? That failure. But if you're using a downsloping picture, then downsloping range, then you can clearly see that there is a commitment to the upside. And more importantly, as this commitment develops as a sign of strength rally, there is a backup into the support that acted before as a point of resistance. So that confirms structurally that indeed this was a sign of strength and a backing up action. And therefore this is phase C and this is phase D. And if you missed your entry on this spring, or let's say on the sign of strength bar, then you could definitely enter somewhere here in this area on the smaller backing up action that belongs to this whole range. All right. Great. Let's go to the second trading range. And
Sure.
Nilesh, let's start with phase A.
Sure. That would be buying climax where your pointer is, and the downward reaction would be automatic reaction,
Hmm.
and then we have a secondary test.
Hmm.
That would be phase A.
Okay.
And then we in phase okay, then phase B again we are testing the same. There is one upthrust action in phase B that I see, and in phase C uh, is
Where
the
is
one
phase C?
in August. After August 9, I guess somewhere around that. Yeah, that's where we are testing the phase B lows for the last time.
Excellent.
Uh,
Mhm.
and that's yeah, I do see an increase in volume there, but I think the downward spread is lower there, and we do not breach earlier supports as well. So that's
Mhm.
a positive sign. Uh,
Still high low relative to the lows in phase A. Hmm.
right,
Okay.
right. And then we have a sign of strength rally, but which it goes to the buying climax, but not really crossing the upthrust action that we had in phase B until later in October.
Well,
Yeah.
think about the definition of the sign of strength. We said that a sign of strength should rally off the lows in phase C, go through the whole range, commit to the upside. So all of this rallies right here, those are kind of like minor sign of strength, right? So they're still in the trading range. They have not overcome all of these points of the resistance that we have in phases A and B. So therefore, you're looking for the commitment that is above all of the resistance lines. Where is it? Well, somewhere here. You also want to see that the price consolidates, spends time above that first push up, and then comes and backs up exactly to the area of the support that acted before as the resistance. So therefore, a sign of strength in the backing up action is being shown to us here, and therefore they belong to phase D.
Yeah.
Okay, great.
I,
Go
I
ahead.
have one quick question.
Mhm.
So in this whole structure, right, what would be, as in, where would you think about opening a position? Would it be in buying, backing up action only, or are there any other interesting levels where you see the signs of upward reversal, or you would wait for
Mhm.
this backing up
Okay, so
actions?
in other words, where else, where would we be opening positions, right? Am I correct? Yeah,
Right.
okay. All right, great, great question. Thank you, Nilesh, and I'm gonna mute you. Okay, so one of the things here right away, and we'll come back to this question in a second. Climactic run is very well defined. So there is a climactic volume here. A climactic volume does not necessarily have to come on the last bar. It has to come on the last rally, though, and be a part of that rally. Um, but we clearly see that there is a momentum move, there is a vertical absorption on the way up, and then there is a climactic run, which is being concluded and followed by a change of character. And I'm looking at the next reaction to the downside, and this looks to me like a test. So I'm starting to think that, could I label it in a slightly different way? Remember how we said that sometimes we could label a reaccumulation as it starts after the backing up action as a shakeout that is being followed just like a regular accumulation labeling, automatic rally and secondary test. So I think this is appropriate here. Buying climax, a shakeout type of action on the increased volume signature, and it doesn't really behaves as a pronounced move to the downside. So right here, even on that, where we see that the distance um, covered by the rally and then the distance covered by the shakeout are just so different. The shakeout is much, much smaller than the distance to the upside. So so therefore, and with the volume signature, we're thinking, okay, maybe like temporary shakeout action. If this is a shakeout, then the next thing that we're experiencing is automatic rally, secondary test, phase A. And we kind of see that the texture of phase A is congruent with all of these thoughts that I've just went through, right? So it seems like all of these tests are belong to each other. There's two reactions. The second reaction is just a test of the first reaction. So that suggests phase A. Then we see that in phase C reaction, this is a different texture. This is a different test. And it looks so different than phase A. It also looks different than phase B, because as we look at phase B, this is the texture. It's kind of like this laborious move to the downside where there's selling, 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 and yet there is no way that the price can commit below the lows in phase A. So that's number one. Let's come back to the question by Neil Ash that was about the points of entry. So in my trading, I probably would be thinking that after the upthrust action in phase B, the move to the downside is actually that move into phase C. So I would be thinking of interpreting this trading range, thinking that this is phase C, minor sign of strength, maybe major sign of strength right here, and the backing up action. So there's an entry somewhere here. The exit out of this position could be here or on the failure of the support right here. So you probably would be ending up with, just a small win. Small win, break even, small loss. And that would be your trade number one. And again, I'm not shying away out of this type of opportunities, out of this type of trades, because I don't necessarily know 100% that this is going to be phase C. I mean, we could go into much deeper analysis and figure out why it wasn't phase C, but at the same time, we in a lot of cases we just don't see that until it actually happens. Plus, the character of the move to the upside was actually somewhat okay. So therefore, after this first trade, if we're still thinking that this is the bias is to the upside and we're defining phase C on the next reaction, our entry is going to be somewhere here. That's entry number one. Our second entry out of the reversal of the LPS, so that's entry number two. We don't necessarily want to enter somewhere here. Why? Because we don't know if the next reaction is going to be such that would take us out and hit our stop loss. So we would just patiently wait until the backing up action after the sign of strength forms, and we would enter somewhere here. So this would be our third point of entry. So we would be entering here, here, and then here. And prior to that, we entered here, and we exited here and here. All right, let's see some questions. Could you start back in July with buying climax? From Philip. Philip, are we discussing the same trading range? It's probably somewhere here, right? So could we start back with July with buying climax? Okay, yeah, buying climax. So we have a small distribution range that produces the cores for this low. This low here is a trading range by itself. It starts here. So here is selling climax, automatic reaction. Secondary test somewhere here, just hidden. Sign of weakness in phase B. up thrust in phase C, everything in between is B, and then a move to the downside. Cell and climax, automatic reaction, secondary test, phase A, and so on and so forth. Right? So we didn't go through this structure, we just went into this structure because that was the assignment, but here it is. All right, next question. Big volume on a spring is bullish or bearish indicator or none? So I'm still thinking that this is the case. Actually, in both cases, the volume signature increases. Now, we will study this in more details, literally like in a couple of sessions. But, and it's so funny how on the same slide we have two different variations. The first variation is kind of like a more normal volume signature where we have an increase of the supply in phase A, and then we have a decrease of the supply into phase B, and then a local increase of the supply from phase B to C, and long-term decrease of the supply from phase A to C, and here from B to C. In the first instance, the volume signature is different. We see that from phase A going into phase C, we actually have an increase in the supply signature. And in both cases, we would be thinking about what? We would be thinking about the result. What is the result of this whole thing? If the supply increases, do we produce a significant commitment to the downside? And we see that there are attempts to commit, but there is no actual commitment below the support area. The same here. There is an attempt to commit, but yet it doesn't. It only sprints below the lows in phase B. So in both cases, result is very crucial for us to identify, and then volume acts more as a confirmation of institutional presence at these spots. And the way how we would be thinking about institutional presence is, well, they are here, so what is happening on this increased volume signature? Well, the price tries to go down to the downside and then recovers, tries to go down and then recovers. So therefore, that volume signature suggests participation of the institutions, and what do? They are buyers at this point. So therefore, the bias is to the upside. Good questions today. I wish I would feel better a little bit. And maybe we could just like even go into more explanation on this. Okay, is the first trading range an accumulation? Well, again, you have to think about the context of everything what is happening here. So this acts as a reaccumulation. This acts as a reaccumulation as well. The definition of the reaccumulation: move to the upside, consolidation, move to the upside, consolidation, move to the upside. So both are reaccumulation ranges. Is August 23rd of 1999 also as a sign of strength? This rally right here, well, we could kind of think that yes, there is definitely like this major sign of strength, commitment to the upside, but I probably would be just thinking that what kind of value it gives us. Probably none. The fact that the trading range, the second trading range, just rests above the buying climax here suggests strength, suggests bias to the upside, but I wouldn't be labeling this whole move as a major sign of strength. I would probably be thinking more about this area right here as a sign of strength in the backing up action. But I kind of see the logic of why you would think so. All right, great. So here is my labeling here. You could go through this as you do your homework. Let's talk about shakeouts and sprint type actions. right? So we've discussed sprints, and I mentioned to you guys that Wyckoff actually did not have a definition of a sprint. What he had is a definition of a shakeout or a terminal shakeout. And a definition of a shakeout is going to be basically a difference between a shakeout and a sprint. So we said that the sprint is either an attempt or a temporary commitment below the support level. Shakeout is much more than that. And I want you just to, on the very simplistic level, to think about the shakeout is it's like a very, very deep sprint. So it's a pronounced price commitment below levels of the support. Right? Look at how many closes we have below here. Quite a few. And distance-wise, it traveled. Right? We also would like to see a much better volume signature here. So more of the increase. And the reason why the volume signature here is not that significant is just because it's actually a downsloping range, and I've used this example in the previous slide. So it acts actually more as a spring in the downsloping range than a shakeout. But in the horizontal range, you definitely are going to recognize this as a shakeout. And this would be a more conventional way of thinking about this concept and specifically thinking about this trading range formation. So what's kind of like the confirmation or the tactics for the shakeout? Well, with the shakeout as well as sprint number 2, our points of entry are always going to be on the test. Think about this for a second. Why do we need the test for sprint number 2 and the shakeout? Well, because both are going to be associated with the increased supply signature. And if supply is increasing, we always want to have some kind of test. And this test always should come as a high or low and on the diminished supply signature. That way it would be a successful test. So where is that test? Well, it's a little bit hidden right here behind these bars. And actually supply does come in again and being observed at the same time. So this acts actually as a very good sign. And we understand why this happens. It just happens before the earnings catalyst. So that's why some volume signature comes, supply comes, there's a lot of hedging before the earnings, and then the price jumps. Okay, let's talk about sprint type action. So what is this sprint type action? So sometimes I would say, oh, look at this upthrust action, right? So in the reaccumulation, an attempt to commit to the upside with the subsequent failure is going to be labeled as an upthrust action. So it looks like an upthrust, but in the reaccumulation, we know that we usually don't use upthrust as a definition, but it's there. It looks like an upthrust, it acts like an upthrust. It is an upthrust only in the accumulation, so therefore we would say upthrust action. It acts like an upthrust. The same with this spring. We could see in the distributional structure that in some instances a sign of weakness could be interpreted as a spring. It would have the same characteristics where supply is diminishing going into the spring, where the commitment below the support is going to be just temporary and just so perfect how it just sprint like this and then came back the next day was the gap up. Educators like Gary Fuller, David Weiss, Gary Dayton, they would be talking about this as a sprint, and rightfully so. It is a sprint. It acts as a sprint. But to be more accurate, let's just define it as a sprint type action, just because we know what has happened next. The price went up and then went down. So we're seeing that this is not an accumulation or reaccumulation. and that this is a distribution. And once everything unfolded, we know that this type of action before phase C is going to be a sign of weakness in phase B. So, and therefore, we would just look at this and we would call it a sprint type action, which is actually a sign of weakness. All right, let's go to the next segment. By the way, were there any other questions on the on what? No, we went through this. Okay, great. Let's talk about the distribution. Let's talk about events and distinctions. So we went through accumulation, the definition of accumulation. Actually, guys, let me take like a 1 minute break here at this point, and I'll be back in a second. Hold on a second before we go into this new material. All right, I'm back. So let's start our conversation about a distribution. Um, so what is happening in the distribution? How does sentiment change through this whole trading range? What do institutional hands and weak hands are doing? How do they behave? Well, it's all been, of course, driven by institutional activity. So we are in the uptrend, and then suddenly we reach some kind of point of value for them. And in some instances, this value is going to be defined also as an overbought condition. You're going to have some overthrows in this area in the major uptrend. And this is where this type of condition creates a very bullish weak hands sentiment. And with this very bullish weak hands sentiment, that produces liquidity availability, which basically suggests that institutions could sell into weak hands strength. And in a lot of cases, that selling starts on the way up. And you could sometimes see how the price goes up, stops, goes up, stops, goes up, stops, and then produces a big change of character. So usually these spots are going to be associated with the tremendous increase in the supply. But yet, because this is just initial selling, it's not going to produce a big downward result. And therefore, it's hidden from us like that. And only a trained eye could see that. And we'll definitely go through that, especially in the second month when we will be discussing, supply signature, demand signature. So we'll go through that. But this is the initial place where institutions are gonna unload their position or close out, some of it, scale out. And this area right here will be defined as a buying climax. It doesn't necessarily have to be like a climactic run. It could be even a trading range. There are so many ways of how buying climax could unfold. But buying climax is going to be associated with the first attempts by institutions to sell their position, to distribute into the strength of weak hands. And this is where weak hands are going to be extremely excited. Weak hands are going to be correct on the bias and correct on their timing in the last portion of the uptrend. This is where they're going to enjoy all of the profits to the upside. You hear usually a lot of stories, from weak hands where they're saying like, I made so much money. And that usually happens on the climactic run. Think about 2017, right? The last 2 quarters, from summer to into the January of 2018. That was the market where we had that climactic run, and this is where we heard a lot of the great stories about how big money were made on the way up. Then comes a change of character. That change of character is going to be very, somewhat sudden, because here institutions are selling as well. And now, instead of selling and no downward result, in this case, on the change of character, they will be selling and there will be an increase in the downward result for the first time. And that's what is going to define a change of character. So behavior has changed for the institutions, and not only that, but the price follows now that behavior in the direction of the institutional force. And that's what produces that change of character. A change of character low is going to be defined as an automatic reaction, and that would define the boundary of the trading range. And if anything, this is just such a great concept, I thought, that Wyckoff has come up with. A trading range, future price action, is going to be condensed between the boundaries of the resistance and the support. This is where the majority of the time the price will be between these two lines. Once we define the boundary of the trading range, the next action for us is a retest, a secondary test. Now think about this. At this point of time, at the automatic reaction, there is some kind of short-term value proposition, and because the price went down, as the price goes down, there is some short-term value. Who's going to take this? Who is the buyer here? Well, institutions have been selling into the strength of weak hands. They've been selling on the change of character as well. So would they be buyers? Now, we were taught that, institutions might actually be buyers at this spot. I doubt that strong hands institutions would be buyers at this spot. Why would they be? There is no logic in this whatsoever that they would be buyers here. Only institutions that are weak hands, that are seeing some kind of value for them, they could be buyers. And if it's a reaccumulation zone, then they would, strong institutional hands would be buyers as well. But I don't see um, how weak hands, institutional hands, would be buyers at the. I'm sorry, would be strong institutional hands would be buyers on the change of character low in the distributional formation. Their goal and intention at this point is just to scale out, to sell. So no buying by strong hands. So weak hands are going to be buyers here. And that's what's going to lead to this next weak rally, which is going to be a secondary test. And that would conclude phase A. The intention behind phase A is the same in distribution as is in the accumulation. It's to stop. To stop what? To stop the previous move from going further up. So we're stopping an uptrend. And all of the elements, including the preliminary supply, where the first sell-in might come, buy-in climax, automatic reaction, and secondary test are going to be a part of phase A. As weak hands are buying on the way up, imagine what happens to them on the next reaction. They're basically saying, this is probably a wrong position for me to be in. And it's going to get them out of this position, maybe on the sign of weakness, maybe on the secondary test, just because there was a reaction and they were expecting more of the move to the upside. So they would get out of this position, and as they get out, that could produce that sign of weakness that, again, could produce some kind of short-term value. The short-term value could finally be picked up by some of the institutions that are going to be, again, weak hands at this point of time. And that absorption of the supply at this low is going to push into the next high. And as weak hands, and like public weak hands, are not participating in this rally, they're regretting that they did not participate. So what do? On the next reaction, they are coming in here and they are initiating the position. So weak hands buying. And at this point, strong hands are just selling, 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 selling. And they try to sell at the upper boundary of the range. As they were accumulating the stock, the shares, in the lower boundary during accumulation, in the distribution, they will always try to be effective with their selling and to sell at the most optimal price, meaning that that price is going to be sell price is going to be in the upper part of the trading range. And of course, depending on how the market reacts to that selling, right? So if the market still wants the shares, that selling in the upper part of the trading range is very easy for institutions. But if the weak hands are less willing to buy the stock, then most likely it's going to be much harder for institutions to sell in the upper part of the trading range. And they would have to push the price lower. So sometimes weaker structures are going to have, structures like deteriorating structures with the lower highs and lower lows. It's just institutions can't really sell everything right away, so they sell and then they allow the price to go up. Then they sell, the price goes below the low, creates a lower low. So they know that, whatever supply they provided into the market, it tanks the market. So they need to be careful as to how they sell. So next time the rally goes up, they're trying to sell maybe less, and then on the way out, they just capitulate their position and just sell everything. And that produces the gaps on the way out, a big spread. Well, if the weak hands got into this position again, so this is second time when they bought, and they're really enjoying the upthrust. because up thrust is going to have a lot of characteristics of the sign of strength. This is where the spread might be increasing to the upside. There might be increasing volume signature as the rally unfolds. And then as the price commits to the new level, this is the becomes the second point of excitement for weak hands. What is the first level point of excitement? Well, we said that it was a climactic round. These are the two spots where weak hands are going to be excited about their position. So therefore, they're going to provide more liquidity to strong hands, institutional hands, to sell into. So we often see that in this area, we're going to see either one bar or several bars with the increased volume signature that suggests the presence of supply. And as it fails, this is the first time where weak hands are going to say, I'm not selling. Why? Why are they not selling at this point? Well, because finally they realize that they have to be disciplined. But unfortunately, they get disciplined at the wrong time. And this whole weak hands, strong hands, weak hands usually defined not just by the incorrect bias. Their actions are defined by incorrect timing as well. And that's kind of like the case here. So they want to be disciplined and they say, every time, I entered this position, the price went down and then the price went up. So now that the price goes down, I'm not going to sell this position because I know that the price will go up again and it will rebound. And it would rebound in the reaccumulation. And unfortunately, if it happens to them in the reaccumulation, imagine the emotional confirmation that they get from that rebound. The rebound is basically just saying, yeah, you should be doing this all the time. And that's how they would be functioning. So at this point of time, they do not give up on their position, whereas institutions are selling into that strength. There is really not a lot of strength just because not a lot of bias on the last point of supply rally. And the stock or the shares are in weak hands. So therefore, this rally is going to be mostly like flat, or it's just going to produce some kind of momentum to the upside, and then it's just going to come down and then tank. So imagine what weak hands do next. As they hold on to their position and the price goes and breaks below the support, what do you think is going to happen here? Well, at this point of time, there is too much of the emotional pain that weak hands are going to have. And by the way, again, weak hands, not just public, institutions plus public, and institutions on the wrong side of the trade. And when they see that the price goes down, they just basically emotionally capitulate and they say, get me out at any price. And that's what produces this big move to the downside. Usually, once the price comes out of the distributional formation, we could see a lot of gaps to the downside that are significant gaps. We could see big spread increase to the downside that are going to be extremely big and extremely significant spreads to the downside. And that's where we know that there is a capitulation that is happening on the way down. All right, as in the accumulation, we would be using Wyckoff events to define phases. We've talked about phase A and all of the events there. And it's kind of like a mirror image of the accumulation. right? So we have a preliminary supply instead of preliminary support, buying climax instead of selling climax, automatic reaction instead of automatic rally, and then secondary test is going to be the same. Then the labeling changes. We still would be thinking phase B as the test of the support and the resistance. And if the test at the support is a low, then we're going to label it as secondary test as a sign of weakness in phase B. High-low is going to be just a secondary test, and then, excuse me, a lower high in phase B is going to be labeled as an attempt to upthrust. And a higher high is going to be an upthrust. So these are the label and definitions in phase B. And then phase C is going to be our final test of the demand, right? So in the accumulation, final test of the supply, here a final test of the demand in the distribution. And it's also going to have either a higher high, which will be labeled as an upthrust after distribution. Why after distribution? Because if this is a distribution, the thought here in the methodology was that distribution has already happened by that time. By the time the upthrust happens in phase B, distribution is done. This is, again, not necessarily correct. The method requires a lot of corrections and adjustments, and this is what I'm kind of trying to do with this course. It's just to put everything on the correct path. So this excuse me. So distribution still could be happening on the way down, even in phase D. There might be some selling on the way down. Distribution could happen even on the way down in phase E. Institutions can still be in the mode of selling. So to me, this is definitionally not necessarily the best semantic after distribution. I would say that maybe this is an distributional upthrust. That's what I would probably say, like DUT, something like that. Upthrust after distribution could be also be tied with tests or multiple tests that come and tests that attempt to go up. And then a lower high in phase C will be labeled as a last point of supply. And then we are experiencing a change of character. The next reaction is going to be the largest reaction in the trading range, which defines that the behavior has changed, and therefore a change of character is underway. The change of character is going to be confirmed by the last point of supply rally, which usually is going to be weak. And after this rally, this is where the capitulation is going to happen as the price commits to the downside. Intentions behind phases in distribution are the same as in the accumulation. Phase A, as I mentioned, is a stopping action of the uptrend. Phase B is a cause building, and this phase defines the relationship between supply and demand. Phase C is the final test of the demand at the resistance level. Phase D is the initial markdown within the trading range, whereas phase E is going to be the markdown outside of the trading range. As usual, I'm giving you the definitions and the characteristics of all of the Wyckoff events in the distribution range. This is something that I want you to print out, to have it in your library, and to study as a homework assignment, and obviously to remember those characteristics and remember this sequence. It's usually when we don't remember the sequence, of all of the labeling events that are happening. This is where we are starting to make mistakes. And this is where I see how the students maybe, not understanding the material. So please make sure that you go through this slide and study and remember characteristics by heart. Okay, let's look at some variations of the distributional patterns. So a conventional distributional trading range would look something like this, where we see a horizontal structure and we could have maybe some higher high interface C, maybe a lower high, where we would have like a last point of supply type of situation. But predominantly the price would be consolidating within the boundaries of the support and the resistance that were created by the buying climax and automatic reaction in phase A. A more alternative schematics and labeling could include a leadership, a distribution of the leadership stock or a leadership instrument. It usually is going to be associated with a very unwilling change in sentiment by market participants in this structure. It has been a leader on the way up, and it still could act as a leadership. And the 2018 market in the US is a prime example of that, where we did have a change of character, and yet we had an upthrust into the climactic high. It more reminds us of this schematic right here, which also defines a distribution of the leadership stock, where a buying climax is being followed by a shakeout type of action. Then we have a reaccumulation type of structure that leads us to the upthrust formation, and then we have a downturn. Now in this market, what's kind of like very, very interesting about this market is that as it went down, it recovered really fast. So therefore, what are we thinking here with this recovery? Why did it recover so fast? Well, it only could recover under one condition, where in the oversold condition, we have some kind of value for institutions. If there is some value for the institutions, what does it mean for the bias? Well, the long-term bias, as they see it, is still up. So therefore, I'm thinking that this whole formation that we're in right now, probably just a long-term reaccumulation. And probably this rally will conclude with some kind of reaction and then a consolidation that's going to lead to potentially next move to the upside. This type of scenario could only be negated when we would see maybe a reaction that's going to bring us to the lows, and then the subsequent rallies are going to be so weak that we're just going to collapse, after those. So it's going to be interesting to look at the next reaction, because next reaction is going to define a lot of the structure that's going to come next. But this is something that if you want to hear more on, you could join us for our Wednesday class, Wyckoff market discussion. So two types of leadership distributional patterns, and then we go into something very, very unique. Both of these patterns, so number 3 and number 5, are of the same family, and they are called TP formations or TP family. So what is TP by itself? Well, it was taken from the Indian hot look. This is how it looks. So there is a move up, and then there is quick move down, speculation on the way up, and then urgent selling on the way down. Why is it so? Well, because there is just like not even extreme, double extreme overbought condition on the way up. Basically a pure speculation. And you've seen this in the Bitcoin just recently. You've seen this in the Chinese market in 2015. So many other examples that we could observe in this hypodermic formation. And this is the biggest difference between, let's say, hypodermic formation than anything else that we see here on this slide. The phases are going to collapse, and the duration of the phases is going to shorten. So therefore, our phase B is going to be short, and it's going to be in line as phase A and phase C. Usually we would like to see phase B as one of the biggest phases, right? Look at all of the schematics. Phase B is quite substantial. But in the case of the hypodermic distribution, this is where there's going to be collapse in duration for phases. Why does this happen? Well, because of the extreme value that institutions are getting and extreme profitability that they have. They don't want to wait and distribute the stock throughout the horizontal formation and take time to do that. They basically say, get me out now, and I don't care at what price. So they're going to sell, sell, sell on the way down, and they're just going to take the profits, whatever profits they can, and that profit, even on the way down, is going to be substantial. We'll study more of these examples, later on and in the practicum as well. Another TP family member is the loss chart, the loss schematic right here. And it's going to have the same type of institutional behavioral characteristics as the hypodermic distribution. There's going to be some speculation on the way up, but then what's more even important is that throughout the initial phase A and early phase B, we're going to see urgent distribution by institutions. And usually, this urgent distribution will conclude initial selling by institutions. And because of that, the price is going to go into some kind of apex formation. And in this apex formation, this is what's going to happen. Weak hands are going to find some value, and they're going to be buyers. But because they're weak hands, their buying is not going to be very intense, and it will never produce the rally that's going to come to the levels of the buying climax. And this is one of the attributes of this TP apex formation. And institutions, the strong hands, they already sold. They don't need to sell anymore. So they are just basically inactive. So institutions are inactive throughout this whole apex formation. If institutions are inactive, then all of the reactions to the downside, just because they are biased already to the downside, are going to be mediocre as well. And that's what creates the apex. Weak hands are buying at the value zone, and then they're just holding on to the position. And then strong hands are just basically already sold out, and they don't want to sell anymore. So there is an inactivity by institutions, and that produces this apex formation. It is being resolved on the way out, and ironically, this on the way out is also going to be led by institutions. They're going to see that throughout, let's say, a couple of quarters, there is no absolute or relative outperformance and this will lead for the final capitulation, and they were going to give up on this position. As they're giving up, the supply is going to increase at this spot, and also the price will start moving to the downside. This movement to the downside will change the sentiment of weak hands, and they're going to start selling as well. And that's why apex formations produce such quick moves on high volume signature, is because if there is a capitulation out of the apex formation, everyone participates in that, and they're going to just capitulate on the way down, getting out of the position, and it just collapses the stock, collapses the price. All right, so definitely something that I want you to think about, that I want you to go through. And especially this slide right here with all of the Wyckoff events, all of the phases, intentions behind those, and so on and so forth. Okay, so I think that we're gonna stop. Okay, so a couple of other things. So cheat sheet on the distribution, phases A and B. This is again something that you need to print out and just keep in front of you, keep it in your library, go through all of these points. This is just another way for me to give you this information, and I believe, as a teacher, that if I give you the same information in different ways, one of the ways are going to resonate more. So this is just another way of thinking about this concept. So just go through this by yourself. Phase C, D, and E, and then your homework for next time. Your homework is still going to be on labeling. We're going to label Microsoft. And it's the same assignment. I want you to label the trading ranges with Wyckoff phases, events, and change of character. So let's quickly look at this. And you could notice that I don't have the volume signature on all of these slides. It's very intentional. I want your mind to think only about labeling at this point. So 1, 2, 3, 4, 5, 6, 7, 8, 9. Yes, okay, great. So 9 charts. Okay, so this is the homework. And then next class, what we're going to do is we're going to look at your distribution homework for today. And we're going to go through that, and we still have some of the material that we need to cover. But this is going to be our last final class on price structural analysis, and then we're going to transition into the supply and demand. Eric is saying here, too much, Ramon. Okay, well, yeah, if you guys are feeling like, for those of you who feel like, oh, it's a little bit too much, go at your own pace. Sometimes when I receive emails like this is a very intense course. Yes, it is. But there is no other way that I know how to teach this material, and there is no other way that I would want to teach this material. It's just me, it's just kind of like a style, a teaching style. So therefore, take your time and go at your own pace. If you feel like you can't go through the whole homework, make it a point just to label at least 1 chart, maybe 2, maybe you can do 3. Maybe you'll find the time and label all 9. And obviously, it comes with the practice. So the more you practice, the faster you're going to see those concepts on the chart, the faster you're going to label those, and so on and so forth. So that's kind of like the key, to study, but to study at your own pace, and don't overdo something like this, where I understand that this is not your job. This is more of a secondary income that you want to create. Maybe it's kind of like a hobby for somebody. So therefore, just pace yourself. All right, let's see at some of the comments. What does it cost to be a part of your Wednesday market update class? Well, definitely go to our website. Let me just see if I could quickly. If I could quickly show you this. So under classes, go to market, Wyckoff market discussion. The cost of this class is $99 per month. This is a monthly recurring payments, so you can cancel it at any point via PayPal or just email us. And this is an hour and a half on the market on the last bar. So yeah, you're welcome to join us. Another question. Roman, for me, the confusion is the difference of sign of weakness or sprain due to reaccumulation. Can have a sprain and distribution have sign of weakness so that it's so similar? Okay, let me rephrase this question so I think I understand it. So the difference between a sprain in the reaccumulation and a sign of weakness in the distribution. I'm going to assume that a major sign of weakness in the distribution. So what's the difference, right? Because they're going to look the same or somewhat the same. Well, there are quite a few things that are going to happen before, right? Even in phase A, as we've studied, there might be some like very average volume signature that's going to indicate to you that this is a reaccumulation. Maybe there is a subsequent supply dry out and maybe just slight increase, local increase of the volume signature on the actual spring. Whereas in the distribution, we might have phase A that's going to be associated with a big supply increase and then increase of the supply signature on the way down. So that could look different. But even if we have not noticed this, then we always would be thinking about the confirmation of those patterns, right? The confirmation of a spring, a confirmation of a sign of weakness. So what would be a confirmation of a spring? The price comes back into the trading range and goes into a major sign of strength. And then with the major sign of weakness, there's going to be an attempt to come back. The price could come back, but then it still needs to react into the resistance and then collapse. So those are going to be two different pictures that you're going to see as a confirmation. So I would concentrate on that first because it's an easy identification, and then try to define the buys throughout the whole structure as you go through phases A and B, which is a much, much harder task. All right. Is there a redistribution trading range setup similar to reaccumulation, or will it just precede by buying climax during overall downtrend? There are quite a few similarities that we could have between a reaccumulation and a distribution. And usually, as we say, like the first 1/3 of the trading range is going to look the same. Now, this statement is correct and erroneous at the same time, because yes, in some instances, the trading ranges are going to, with different bias, with the reaccumulation and the distribution bias, indeed, they're going to start the same way. And actually, I have an exercise for you for the second month where we're going to look at something like that. And yet, the resolution of these ranges trading ranges are going to be different. So we'll talk about that difference more. But on a very kind of like simplistic level, yes, you're gonna see distributional patterns that are gonna look a lot like an accumulation, or reaccumulation rather. I've started session number 1 with the examples of the trades that I made. Go back to that session and rewatch a trade in Navadia. I've mentioned to you that throughout the whole trading range, this was one of the leadership stocks that was on my watch list still as a reaccumulation. And I don't think I don't see anything wrong with that definition. Yes, we know that Novadia went down, and it would be dishonest for me to tell you that I was thinking of the distribution all the way through the trading range. That's just not how I function. I was thinking about the reaccumulation, so I'm going to tell you this. And then some elements that came later on after the upthrust that suggested the change of character and defined the bias to the downside. And that's when I figured out that now it's going to be distributed, and it's going to be distributed, relatively fast. So we're looking for those type of the definitions. Whenever you're asking me a question like that, you're looking for a linear solution to a complex multivariable type of problem. And you can't solve this problem in a linear way. Or you can solve it in a linear way, but you have to have the capacity to connect so many different variables, so many data points, and you just can't. As a human, you can't. I think that, if you're using maybe like supercomputers, you probably can, but you still have to define the rules even for the supercomputer, unless you define the artificial intelligence rules, and then the system learns how to identify it. But for now, the key is concentrate on the concepts, and then be fluid, be dynamic in your analysis. Don't be linear. Don't be thinking that, it has to be all rule-based. Yes, it has to be, but in a lot of cases, it has to be conceptually based, concept-based, right? So concept comes as a change of character, bias changes, and therefore a good trade is being produced. Okay, what else? Okay, so I'm just gonna conclude here with one last remark, and that's it. I'm gonna go on the rest. Um, this comes from Rick, and he says, "No other way I would want to learn. This is my life to trade. This is my job." Um, and I love this because I'm the same way. You guys could definitely feel this, with each session that. Uh, I've developed quite a passion for trading, for markets, for this material, the way how the logic works with all of those details and so on and so forth. And I definitely know that there are quite a few people in this class who has the same passion, the same kind of like dedication, commitment to this material, which is great. But I also do not want to oversee other students who maybe do not have, the same amount of time and the same type of commitment just because of how the life is, right? There are other things, more important things than this even. There are families, there are jobs, there are other things that responsible for. So totally get this. Do not stress about that at all. And go at your own pace. The key is just to stay in this system, right? To stay in this educational system and try to get the most value out of this education. So therefore, come to the class, be present, be conscious when you are in this class. This is one thing that when you come to this class and you're tired and your time is limited, do yourself a favor. Stay conscious for this 2.5 hours and stay present because you're going to gain a lot of knowledge and you're going to gain a lot of material from this. But if you're not paying attention, then it's kind of like, you're there, but you're not there. And then if you can't rewatch the video again, that's fine. If you can't do the homework fully, that's fine as well. Maybe in the future you could re-listen to the course, rewatch the course, and do those homeworks. So I've been teaching for quite some time, and at the beginning of my teaching career, I was, so strict with students, and then it took me, a time to understand that people have, their own lives, and there are some things that are much more important than this. So define your commitment and involvement in this course by yourself. Let me know how you're doing this, and I support you all the way with whatever path you choose. With these guys, I'm gonna say good night. I'm gonna try to post this recording tonight, and then I'll see you all next week on Monday. Send me your homeworks. Thank you, guys, and I'll talk to you later. Cameron, thank you so much. Bye-bye.